segment. We're joined now by Jeremy Nelson, partner at Element Wealth. So, Jeremy, appreciate you coming down on such a short notice. Can't think of a better day than today to come in and have you impart some of your wisdom and your analysis of what in the world's going on. We were turned around looking at the screen here. We're off the lows of the session.
A little bit off the lows, yeah.
Yeah. The futures were down, of course, and that, I think, was in response to the Nikkei, a huge sell-off in Japan, and then the European markets as well.
Yeah, and this has been going on for, about a week now.
Yeah.
And, the reality is that some of this has to do with the economic data that we got. But more than anything, this is a massive unwind of leverage in the global financial system.
Explain that to our audience, what you mean by that.
So what's happened for a long time is hedge funds and global institutions have used the yen, so the Japanese currency, because interest rates in Japan for a very long period of time have been systemically lower than the U.S. And so what would happen is people would borrow in Japan at next to nothing, right? And then they would
negative
invest.
For a while,
yeah.
were they not?
Yeah.
Negative. Meaning you paid
exactly.
money if you kept
money
it in
was
the bank.
money was free, right? So you could go borrow money in Japan for basically free, right? And then go and invest. And what's happened is the yen has rallied about 15% now.
Yeah.
Because just like our Fed got hawkish in 2022 and started really raising interest rates, well, now you're getting a hawkish tilt from the Japanese central bank. And so the Japanese yen is really rallying, and it's unwinding what they call this carry trade. So it just means that globally there's a lot of selling pressure.
Yeah.
And, you throw on top of that you got, a weaker than expected jobs report. All of a sudden, you've got the manufacturing index in the U.S., kind of at what would appear to be recessionary levels. And now you just kind of have this full-fledged sell-off in every risk asset that's out there across the globe, right? You can look at the European markets, the U.S. markets. Now, the areas that are getting hit the hardest, obviously, are Japan with this and tech stocks.
Yeah.
And then, obviously, cryptocurrencies.
Well, the tech stocks were awfully frothy with some of the valuations on PE. I mean, there's been good growth, and they've been posting pretty good earnings, but I think it was Google that came out, kind of bursted that bubble a little bit with some rather tepid guidance, their outlook.
And that's, one, if you are a long-term investor, you have to look at where you were at the beginning of the year or where you were even in October and where you are today. You're still okay.
Yeah.
Right. I mean, this is not a bear market yet. This is just a correction. And sometimes in markets, corrections happen really, really rapidly. And the number one thing is to, not be emotional about it. But we are at a point where, valuations had gotten so stretched. And we talked about this on the show, a few weeks ago. And one of my big points was valuations can't keep going up forever, right? And if you look at a lot of the Mag 7 stocks, right, the Apples, the Microsofts, those, again, great companies, they are not going anywhere. But if you look at their price to sales ratios, price to earnings ratios, any valuation metric, a lot of the growth has just come from the fact that we're paying a lot more than we used to pay for them.
Yeah.
A lot of these companies went from 3 times sales to 8 times sales. And so you're paying a lot more for these companies, which means there's a little bit of air. And so what you're seeing now is the froth coming out of them.
Or 20 earnings to 40 earnings, right? I mean, we saw that as well. So I talked about this on the program last week, your point about these companies aren't going anywhere and they're still in good shape. I mean, Microsoft posts their quarterly results, and they disappointed because their growth in their intelligent cloud business was only 29%, a quarter over quarter. So.
And the thing to remember is that whenever you get high multiple stocks, especially when you're talking about companies that are now worth more than $3 trillion, I mean, these things are huge companies, that they're priced for perfection. And any disappointment becomes a major disappointment in the stock price.
Yeah. Well, I mean, so that's a function of the high PEs and the high valuations. But if you're a long-term investor, you've been benefiting from that.
Well,
so to see it pull back a little bit is...
Exactly, right. Nothing goes straight up, and nobody is ever going to time the exact movements of everything. This is something that we've been concerned about for a while. We've talked a lot about, hey, dividend-paying stocks look pretty cheap. And, when you look at this correction right now, if you look at like the high dividend ETF from iShares, it's only down 2.5% right now.
So, we've talked many times on this program, and you've been on, we've discussed it as well. Janet Yellen and Jerome Powell. Janet Yellen, of course, Secretary of the Treasury. Jerome Powell, Chairman of the Federal Reserve. Both of them, you remember this, in 2021, when we started seeing a little tick up in the CPI, said, oh, this is transitory. And they kind of got caught with the shorts down. The Fed reacted, I think, a little late, honestly. Most economists would say that.
Way late.
Late, yeah.
And again, yes, there were aspects to the inflation that were transitory.
Yeah.
That had to do with ports being closed,
supply chain problems, logistics,
issues. But what they missed, and what was, I think, obvious to everyone else, was you've printed all this money.
$6 trillion.
And that isn't going to be transitory. Now, we are at a point, and this is where you were just talking about it a couple minutes ago, but I think it's a very important thing to understand. The COVID money is now gone, right? So we are at a point where, we didn't get a recession from the higher interest rates in 2022 and 2023 like people thought we might.
Yep.
And so the market went up, and everyone was a little bit surprised in 2023, and it continued. But a lot of that had to do with the fact that you had all this money that was still sitting there in people's checking accounts. Well, that money is now burnt off, and consumption is 68% of the economy, and so you're starting to see a little bit of stress on the consumer at this point in time.
So right, and my sentiments exactly like you don't have this disposable money you once did, and you saw people going out and traveling and buying new stuff, and lots of retail markets were benefiting from all that additional disposable money. That doesn't seem to be the case anymore. Something else I saw a report on, I'm sure you did as well, that like school supplies, that's top of everybody's mind right now, up like 24% year over year, something insane like that.
Yeah, so I mean, if you think about the average American or, our average listener, and you think about what it costs you to go out to eat, what your school supplies are, it's a lot. I mean, I was having a beer after work at Buffalo Wild Wings the other day with a friend because I hadn't seen him because I'd been on vacation, and our waiter came up to us and said, look at this ticket. These people got, cheeseburgers, and it was X amount of dollars. And it was shocking, right? And I started thinking, well, if somebody makes, $20 an hour, it was before tip, 3 hours of work for cheeseburgers and Cokes. And that, the cumulative effect of inflation and the fact that inflation compounds, it's fine that the rates come down, but it's still compounding on those higher numbers that we had for, the last 2-3 years here. And so I do think that you are starting to see stress at the consumer level.
So now there are some who are speculating or trying at least to guess, will Powell call a special meeting before the regularly scheduled meeting in September to do a rate cut? Will he do that? And I'm not necessarily sure that would cause the markets to start trickling upward. In fact, I think just the opposite.
Yeah, well, so I saw on CNBC before I came in, Bob Pisani was on, and he said that would be good for the markets. But then the other hosts and guests were saying, well, we actually think that would be negative. I personally believe that would be negative because it would show that the Fed is worried.
Yeah, about a recession.
What you just had meetings previously. What happened between your last meetings and now that changed so dramatically that you're worried that you have to make an emergency rate cut?
Man, it just feels like, I don't want to say they don't know what they're doing. These are smart people, obviously, but they seem to be hesitant, I guess, to take swift action and the necessary action. Are you saying now that there's like 16 rate cuts now predicted? We went from like 7 to none to 3 to now 16.
Which, again, why would you get that many rate cuts?
Because we're in a recession.
Because we're in a recession.
Yeah, exactly.
Right? And so that's we traded on the Fed, and we had this this paradigm where, bad news was good news. Well, bad news is bad news now, right?
Yeah.
And you can't live in that paradigm where bad news is good news forever.
Too much Fed watching on the market's part.
The markets are way too reliant on what the Fed does.
Instead of good old-fashioned profit, which is what we ought, the technical of that.
The fundamentals, companies that grow and make money.
We got Jeremy Nelson in the Element Wealth studio. We're talking about the markets today, stepping aside for a break and coming right back. With Jeremy Nelson, partner at Element Wealth, talking about the stock market sell-off today and just the economy in general. So do you think Jerome Powell's going to call a special meeting? What are you hearing from within your industry?
I would be very surprised if he did.
Okay.
Right, because they've got the September meeting. You would have to see the markets go into free fall even further. Because remember, this is still just a correction. This is just the froth coming out. Look, the S&P 500 as of this moment still probably up 8% this year. Right, the Dow's pretty flat. Tech stocks are up about 6%. Dividend-paying stocks are up 7-8% this year. So just because you get a sell-off from some kind of exorbitant highs, right, I would be shocked if they, at this moment in time, went to do something in a special meeting, because I personally think that would be a sign that there's some major, major economic weakness. And the number one thing about the Fed is that they control expectations, and people's expectations, like businesses and consumers, it controls what they do from a spending perspective. And if they went and did some emergency cut because they were so worried about the economy, that might cascade into a real slowdown in spending at the business level, real slowdown in spending at the consumer level, which could make things potentially worse.
Well, and I was talking earlier about capital investment and capital in expense in general. Companies buy from other companies when they acquire assets that are in that category of capital investment. That's what drives the economy as much as consumers do, but that investment's made because consumers are pulling it through on the other side, right?
Yeah, exactly. Yeah, I mean, if you look at the GDP formula from Economics 101, right? Consumption plus investment plus government spending plus net exports. Right. And that's how they figure out what the GDP is. And so, investment is a major portion of that. And, you don't want to see corporations pulling way back on investments in growth, because that really could hit the economy pretty significantly.
That's a key indicator. I mean, the markets watch that religiously.
And again, right, like you made a great point there. Why do companies pull back on investment? Well, because they're worried about the consumption, that they're not going to make the sales. Yeah,
exactly. So, but to some extent, Jeremy, let's talk about this for a second, the political aspect of this. Because as is almost always the case, people vote their pocketbooks. It seems like when things are going well, then they start looking at voting on the basis of other issues, social issues, cultural issues, things like that. But, man, when it's staring them in the face and they're struggling to make ends meet, immediately that just elevates to the top of their concern list.
Yes, so I think that as you go kind of into the primaries, a lot of it revolves around social issues. And then as you get closer and closer to November, the reality of what people actually vote on is their pocketbook. And I think that, what happens with the market between now and, let's say, Halloween, or maybe a little bit before, that's going to really shape people's opinion about the economy, right? Because it's the economy, stupid, right? And so I think that, what happens with the markets from here until we get closer to the election is going to tilt some of those moderates in those swing states, right? And if you look today, at the kind of projected electoral map, there's about 5 states that are going to drive this.
Has been for several cycles.
Yeah. And, it looks like, basically if Trump were able to get Pennsylvania, that would get him to 270 based off of how the map's lined out right now. And that's with me assuming that Georgia stays, Republican. Yeah. And so that's gonna be the big driver. And I think that if the market were to continue to weaken, I think there would be a loss of confidence in the current administration. Right? It's just like if we go back to 2008, John McCain didn't stand a chance.
He was up in the polls right before Lehman Brothers went down.
John McCain didn't stand a chance because all of a sudden, here we go, financial crisis. Republicans had bid in, and so there was no way that he was going to win. And then it became kind of a landslide, for President Obama. I think the same kind of thing could happen. I think we've seen, some of the polling close, right? Obviously, President Biden started to really lose confidence in just generally his ability to make it 4 more years. And, so obviously he stepped down finally. It looks like Harris is going to be the nominee. The polls have kind of closed in here a little bit, but she's going to have a tough time if these markets don't start improving, because it's going to be a reflection on the Democratic Party. And I think that becomes an advantage for President Trump, who, the market, generally speaking, outside of COVID, was pretty good under him.
Yeah. So I'll I'll extend that thought a little further and get your take on this. While certainly a lot of folks are paying attention to the markets and they're looking at their 401k plans, et cetera, and they're not liking what they're seeing, it's when we start seeing people lose their jobs that will have the most significant impact of all, I think,
yes,
on a person pulling that lever when they vote. When the banking crisis hit in 2008, we saw massive job layoffs as a result of that.
Yes.
Just cratered the economy.
And what we've seen so far on the jobs front is that basically major corporations had, at the end of last year, they had stopped hiring a lot of their temporary jobs, or they were letting temporary jobs roll off. They hadn't really dug into their workforce yet. The risk becomes now that they do start digging into their workforce and that we start to get, negative employment numbers. And again, with what's going on in the market, with the potential for slowdown in consumption, that is a real risk. And, we've been very steadfast in saying that the rapid change in the monetary environment hadn't been reflected in the economy yet for a couple of reasons. Number one, what's our biggest debt? Our house. Well, everyone had locked in low interest rates, so not a lot of people had these higher mortgages yet. More and more people are getting them now, right? So that starts to hit consumption a little bit. And, just broadly speaking, we just hadn't seen, the money from COVID that was sitting in people's checking accounts burn off. So they were able to continue to consume by spending this money that had been given to them by the government. Well, that money's gone now.
Yeah.
And so it's going to be harder to create the economic growth. The risk of layoffs is going up as we move forward, and the risk of a recession is much higher today than it was, say, 18 months ago or 12 months ago.
I think the Democrats are going to have problems, Jeremy, because they've to a great extent de-emphasized the whole inflation story, and they've been way more focused on jobs, which really, I don't know of any policies they passed that I guess drove job creation. I think that was just a natural reaction to opening up the economy after the COVID situation.
That's it, yeah. I mean, the major increase in jobs was, a lot of jobs just coming back.
Yeah.
Right. So all of a sudden, companies that had done layoffs or had frozen hiring completely because they were concerned, they didn't know what the future was looking like, they got a lot more confident as we got past COVID. So all of a sudden, you had a lot more jobs being created. But now is where the rubber meets the road.
Yeah.
And I think what you're seeing is corporations are a little bit more tepid. They're really focusing on their balance sheets. They're focusing on expenses, right? They want to make sure that they're positioned that if we do go into a recession, that they're going to be a little bit insulated.
Well, you saw Intel, 15,000 they announced they were laying off, while at the same time receiving $8.5 billion of corporate welfare through the CHIPS Act. Mm-hmm. So we're giving a company $8.5 billion who then goes and lays people off because of the market realities of what they do. And so that, I think, was a harbinger. It had its biggest single sell-off, right, decline in the history of the company.
Yeah, I think it was down, like 25%
in one day.
And so, again, this is the thing that everybody has to remember. We've all been caught up in this AI story.
Yep.
Right. And so that drove a lot of the tech stocks. And so you started to see everybody saying AI, AI, AI in there. Every time any executive spoke, right? We have to mention AI so that the market likes it.
Right.
But then all of a sudden you started to see, some of these companies talk about, hey, we're over-investing in this because it's better to overinvest than to underinvest. Well, if that CapEx spending starts slowing down, that's a bit of a challenge.
Well, Microsoft, Amazon, all the big data center players, the big cloud services player, the combined investment they're planning in the next 24 months is like $1.4 trillion. It's insane, the amount of money they intend. So I think the prospect is still there. The opportunity is still there. I think we're just having a temporary setback.
The question becomes, what's the return on that investment?
Sure.
Are they going to be able to drive enough revenue off of those investments?
These are pretty smart people running these companies. These aren't fly-by-night, flash-in-the-pan type .com companies.
No, I've got a lot of confidence in them, and I think long-term they're going to be real winners. The question is just in the short run.
Appreciate it.
Yeah.
Yep.